$1 billion mortgage scandal is rocking the industry. The Consumer Financial Protection Bureau has now sued a subsidiary of Berkshire Hathaway for predatory lending practices, all revolving around affordable housing. This is a sad situation, and I'm going to break it down for you in today's video. And then at the end, I'm going to show you 3 ways you can potentially protect yourself against predatory mortgage lending. Hey, if you're new here, my name is Jason Ferrier. Welcome to my channel. I'm the Housing Nerd. I'm a realtor and investor just outside of Columbus, Ohio. I love hearing from you. So comment below, what do you think about these predatory lending practices? Also, like the video and subscribe to my channel. I hope you do. Okay, so the article we're going to review today is from the CFPB. And the title of the article is pretty shocking, right? When I saw it this morning, I was like, I got to share this with you guys. The CFPB sues Vanderbilt for setting borrowers up to fail in manufactured home loans. So Vanderbilt is the lending arm for Clayton Homes. Clayton Homes manufactures mobile homes, and they are a sub or owned by Berkshire Hathaway. So it says Berkshire Hathaway owned company pushes people into unaffordable loans to purchase Clayton homes. And this is a crazy article. So today, the Consumer Financial Protection Bureau sued Vanderbilt Mortgage and Finance for setting families up to fail when they borrowed money to buy a manufactured home. And the reason why this is so horrible is this is like the entry-level buyer. Like a lot of these homes, and I know because I've helped people buy them before, not from Clayton necessarily, but homes that already existed, out on a farm or something. Sometimes people buy these homes because it's the only home they can afford. A lot of times they're in rural areas, right? And a lot of times they don't qualify for normal financing, depending on the type of mobile home and the type of property. So they go to a Clayton dealer and say, hey, I like this nice new manufactured home. What do you mean it's only going to be 80 grand or 90 grand or something? But then what it looks like is happening is that the lending arm, Vanderbilt, is actually, taking advantage of these people in their time of need when it comes to affordable housing. The CFPB, say that 5 times fast, alleges that Vanderbilt's business model ignored clear and obvious red flags that the borrowers could not afford the loans. It sounds suspiciously like 2008, doesn't it? Comment below. I want to know what you think about this article. As a result, many families found themselves struggling to make payments and meet basic life necessities. No kidding. Vanderbilt charged many borrowers additional fees and penalties when their loans became delinquent, and some eventually lost their homes. Again, it's a one-stop shop. Be wary of one-stop shops. Like, hey, you can come to my manufactured home lot, buy here, pay here. I'll even give you, financing at 20% interest or something crazy, right? The interest rate is definitely higher on these homes. There's no doubt. It's not 20% probably, but it's probably at least 9 or 10. The CFPB is seeking to stop Vanderbilt's illegal practices and obtain relief from the harmed home owners. They call them illegal. Wow. Vanderbilt knowingly traps people into risky loans in order to close the deal on selling a manufactured home, said CFPB Director Rohit Chopra. The CFPB's lawsuit seeks to not only protect home buyers, but also honest lenders helping people to finance a purchase of an affordable home. There are good companies that will finance manufactured homes because, again, sometimes that's the only option for people to purchase. They can't afford what you would call a stick built or home that was built with a foundation and then the actual home built on site. We talk about who Vanderbilt Mortgage is. It's a non-bank financing company based in Maryville, Tennessee, that originates loans for manufactured homes across the country. Vanderbilt is a unit of Clayton Homes, which is the largest manufactured home builder in the U.S. and a wholly owned sub of Berkshire Hathaway, the multinational conglomerate based in Omaha, Nebraska. Oops. Vanderbilt originates mortgages for the purchase of manufactured homes that are built and sold by Vanderbilt affiliated companies. Manufactured homes or mobile homes are a vital source of affordable housing, particularly for millions of low-income Americans and for older Americans. For these homeowners who predominantly live in rural areas, manufactured homes can fill the gap left by the lack of affordable site-built homes. Yeah, I've shown a ton of these homes. They may have been Clayton homes. I really don't know as far as the manufacture of them, but when you're out in the country and there's acres and acres that you can build on, it's expensive to build. So a lot of times somebody can afford maybe to buy an acre of land out in the country, and then they have a manufactured home brought in and put on site. Or sometimes somebody sells a piece of property where the home's already there, but it wasn't built on site. It was built somewhere else and then transferred there. That's what makes it a mobile home. Then when they put it on the foundation, it becomes real tax property. And at that point, it'll qualify a lot of times, depending on the year built, for FHA financing. But at the onset, when it's actually bought at the manufacturer, a lot of times borrowers and buyers will use the finance division of the manufacturer. And in this case, it was Clayton and Vanderbilt. Although manufactured homes may be more affordable to purchase, CFPB research has shown that manufactured home loans often come coupled with higher interest rates and limited opportunity to refinance compared to traditional home mortgage loans. Yeah, if you're going to buy a manufactured mobile home, you got to know your options, because there's a ton of little nuances to manufactured home loans. And you don't want to get trapped in a loan that doesn't work for the future. In response to widespread problems in mortgage originations, including systematic failures to consider a borrower's income when making loans, Congress in 2010 required that all residential mortgage lenders document and verify borrower's income before making a mortgage, and that mortgages only be made after the lender has made a good faith effort to reasonably determine that the borrower can repay the loan. Those systematic failures contributed to the 2008 crisis. This sounds a lot like it. So they allege that Vanderbilt failed to make reasonable good faith determinations of borrowers' ability to repay the loans as legally required. Specifically, the lawsuit alleges Vanderbilt, check these out, these are nuts, manipulated lending standards when borrowers did not make sufficient income. Sounds a lot like the GFC. In this underwriting process, Vanderbilt often disregarded evidence that borrowers did not have sufficient income or assets to pay their mortgage and current obligations like food and healthcare. Sometimes Vanderbilt originated loans for borrowers who were already struggling, making their financial situation worse. For example, Vanderbilt approved a loan for a family with 33 debts in collection and 2 young children. The borrowers fell behind only 8 months, no kidding, after getting the mortgage. It's just nuts. Fabricated, unrealistic estimate of living expenses. Vanderbilt justified its determination that borrowers could pay the loans by using artificially low estimates of living expenses that made no adjustment for higher expenses in different geographic areas. Vanderbilt's estimated living expenses were about half the average of self-reported living expenses for other similar Vanderbilt loan applicants. These families were left with little or no buffer to cover unexpected expenses. For example, Vanderbilt left one family of 5 with only $57 in net income after Vanderbilt applied its estimate of living expenses. That family first missed a payment only a year after signing the mortgage. No kidding. Loans made to borrowers it projected could not pay. In some cases, Vanderbilt violated its own policy and made loans to borrowers who, even under the company's overly optimistic estimates, did not have enough income to cover the mortgage and basic living expenses. For example, Vanderbilt approved a mortgage for a single mother with 2 dependents after estimating she had sufficient income, and then sent her loan to collections when she missed a mortgage payment after only 4 months in the home. 4 months. You buy a new home, you qualify for financing, you're all excited, you're proud, right? I got my new home, I'm moving into it. These manufactured homes, the new ones, when they're built, even some older ones, aren't bad homes. Like, they're inside of them is pretty nice. So she's probably proud of it. Oops. She couldn't pay. Vanderbilt knew she couldn't pay and gave her the loan anyway just to close the deal. So they say the CFPB alleges that Vanderbilt violated the Truth in Lending Act and Regulation Z when Vanderbilt originated loans to borrowers who lack sufficient income or assets beyond the home to make payments on the loan. Vanderbilt set those families up for failure right there in black and white. So to me, this is just sickening that lenders are still preying on folks that are just trying to get an affordable house. So tell me what you think. But I suspect that Vanderbilt is not the only lender out there doing this to consumers. Now, Subprime lending was supposed to be a thing of the past that occurred during the GFC, and we put a bunch of rules in place to protect people from this. And it looks like the CFPB actually actually was able to catch these guys and now doing something about it, which is great. But do you think they're the only ones, or do you think there's a lot more out there that we're going to find as time rolls on? I suspect there will be. I know I'm not sure it'll cause a GFC type event, but it'll definitely hurt the housing market. And this is hurting affordable housing, which is normally the one that's hurt the most. Just a sad situation. So I've got 3 things you can do. Number 1, know what you can afford. If you know you can't afford the payment, don't buy the house. Just because you're approved for a certain amount of money doesn't mean you need to spend that amount of money. You need a payment that you can afford in good times and bad. You also need an emergency fund. That goes with the affordability. If you don't have an emergency fund set aside for job loss, financial catastrophe, illness in the household, whatever, COVID number 2, if you don't have an emergency fund set aside, that means you can't afford the house. That's my number 1 rule with buyers. I always tell them, you need to afford this house we're looking at. Don't stretch yourself too thin just to get into a house, because there are things that happen in the house. There's things you're going to want once you buy the house. Air conditioning breaks. You're going to want maybe some bathroom fixtures. You're going to want some landscaping. Maybe there's all of a sudden there's a roof problem or something, or a gutter needs fixed. You need money set aside to cover those items. So know what you can afford. That's the number 1 rule. Number two way to protect yourself from this type of activity is to shop around. You've got to shop around for the best mortgage rate and best deal. And also, you want to shop around for the one that you trust the most. So don't just get one quote from the manufacturer and say, that's what I'm going to do. No, contact a lending professional, contact a realtor, contact an attorney, and get some other perspective on the quote and the mortgage rate and terms that you receive from the mobile home manufacturer, whatever lender you're going to. You want to shop that around. Don't just go with the first one you see. Number 3, read everything. Read everything. And if you don't understand something, ask for help. Don't just read something and go, that sounds weird, but oh, well, I just want my home going to sign. No. Read everything. So those are my 3 pieces of advice. Know what you can afford, shop around, and read everything and understand what you're signing. All right. Now, if you want to know more about mortgage delinquencies and problems in the mortgage industry, check out this video right here.